This is Nightly Business Report with Tyler Matheson and Susie Gehring.
World focus. The European Central Bank cuts interest rates. NATO leaders meet to talk global hotspots. What will it take for markets to pay attention?
Different paths. Europe is cutting rates. The U.S. is gearing up to hike them. What happens when Europe and the U.S. move in different directions?
And ready to pop, a look at some of the stocks analysts think can rise 20%. We have all that and more tonight on Nightly Business Report for Thursday, September 4th.
Good evening, everyone, and welcome. Thanks for joining us. Well, stocks edged a little bit lower into the close today, but things didn't start that way. In fact, the Dow and the S&P 500 both hit record intraday highs this morning, driven there by a big Draghi jolt. Who's that? What's that? Well, Draghi, as in Mario Draghi, head of Europe's central bank. And today in Frankfurt, he took monetary steps that electrified markets first in Europe and, for a time, here in the United States. He slashed interest rates to fresh record lows, nearly 0%, and announced some Federal Reserve-like bond-buying stimulus measures to boost the struggling Eurozone economy. But the Draghi jolt faded. Wary investors pulled back ahead of tomorrow's big August jobs report. Indeed, two unemployment numbers out today, unemployment claims and private payrolls. They were both weaker than expected. At the end of the session, the Dow down 8, the Nasdaq lower by 10, and the S&P off by 3. The dollar rose as the euro fell to a one-year low on those actions by the ECB, dipping below $1.30 for the first time in a year.
Despite today's modest sell-off on Wall Street, the U.S. stock markets are still hovering near historic highs. The American economy is growing, and the U.S. Federal Reserve is not only pulling back from its stimulus measures, but talking about raising interest rates. In Europe, things are completely different. The central bank there is trying to avoid a recession and is pumping money into the financial system to stimulate growth. Steve Leisman has more on two continents, two economies, and two divergent policy paths.
European Central Bank President Mario Draghi surprised markets around the world by announcing new measures to stimulate the beleaguered European economies. The euro plunged by 1.5% as Draghi announced the ECB was set to buy bonds to lower interest rates and cut the central bank's own interest rates, lowering one from 0.15% to a still lower 0.05%. and cutting another from a negative 0.1% to a more negative 0.2%. What's a negative rate? It means banks have to pay the central bank to keep euros on deposit there. Draghi suggested even more could be on the way if the current round of stimulus doesn't do enough to reverse the continent's flagging growth and declining inflation levels.
Should it become necessary to further address risks of too prolonged a period of low inflation, the Governing Council is unanimous in its commitment to using additional unconventional instruments within its mandate.
All this in stark contrast to Fed Chair Janet Yellen, who is facing increasing pressure to raise rates sooner. A report on the service sector today was practically near boom time levels. Unemployment insurance claims are low, and Wall Street is expecting another strong jobs report tomorrow for the month of August. While the two central banks move in different directions, the policies could be complementary, at least short term. While Yellen eases back the Fed's easing, Draghi is pushing on the throttle, potentially reducing the pain of a Fed course reversal. While Yellen likely next year will take action that could raise interest rates, Draghi's taking action to lower them. And it's had a powerful effect on not just European rates, some of which are below 1% for 10-year bonds, but also on U.S. rates. While a weaker euro will challenge U.S. companies, especially exporters, whose products could be somewhat less competitive in dollars versus euros, a stronger European economy will help the U.S. The downside could come down the road if Yellen needs to raise rates to fight inflation, but the ECB's actions make it difficult for her to do so. But that's a problem for another time. The immediate issue right now is Europe and avoiding another recession. For Nightly Business Report, I'm Steve Leisman.
Europe's economic challenges are one thing. National security threats are quite another. And today in Wales, President Obama met with other NATO leaders to discuss what to do about Russia and whether its bellicose moves in Ukraine will mean more sanctions or maybe even more defense spending. The Middle East was on the agenda too. Hadley Gamble has more from Wales.
The first day of the NATO summit is coming to a close here in Wales, and leaders are still working to find some kind of consensus on what to do about Russian aggression in Ukraine. Now, this is an alliance that's really been galvanized by the events of the last several weeks, including what's been happening in Ukraine, but also what's been happening with the Islamic State. Many European leaders, of course, worried about what to do about the spread of Islamic terrorism. They understand that as this movement spreads out of Iraq, out of Syria, targets will be in Europe and targets will be in the United States as well. So certainly a top priority for leaders gathered here. Another big topic is defense spending. We've seen European leaders committing today to a resolution. They say that in 10 years' time, all of them will be committing 2% of their GDP to military spending, to the defense of the NATO alliance and to their own countries. But it's a non-binding resolution, so we're really going to have to wait and see if that comes to fruition. Also, in terms of NATO, in terms of the alliance, we're also going to have to see what they're going to do about the Islamic threat. Many options on the table, but no clear-cut strategy or plan as well. And in terms of dealing with Mr. Putin's territorial ambitions, that all comes really down to the fact that the European leaders that I speak to, the NATO leaders that I speak to, are telling me that they want to use soft power. They want to use diplomacy. They don't think that a military solution is really going to work. So some tough questions for leaders here at the NATO summit. One day down, one to go. For Nightly Business Report, I'm Hadley Gamble in Wales.
So how important are all of these international cross-currents for U.S. stocks? And is it time for American investors to pay more attention to trouble spots around the globe? Joining us now to talk about this, Art Hogan. He's Chief Market Strategist at Wunderlich Securities, and Ian Bremer, President of the Eurasia Group, a political research firm. Ian, Art, thanks for joining us. Sure. Just to kick off our conversation, I'd like you to take a listen to the views of two top investors over the past couple of days, and then like to get your reaction. Take a listen.
What I've been doing over the last week or so is reducing my exposure and moving a portion of my portfolio to T-bills, not because I think anything's going to happen tomorrow, but because I don't understand how you can have so much chaos in the world and still have prices going up every day.
Do you remember another time where there were more issues going around the world all at the same time, any one of which could overnight turn into a major disaster? You want to talk about ISIS, you want to talk about Gaza, you want to talk about the Ukraine.
So, Art, let me begin with you. Do you feel the same way as these two guys?
Well, it's interesting. I do. I think, you know, there's as much concern on a geopolitical front globally as there has been in the 25 years I've been in the business. That said, you know, we have to rationalize that down to economic terms. And when you try to do that, you look at each individual crisis and say, what does it mean to both the domestic economy and the global economy, and what type of effect can this have? It's hard to draw, you know, yourself out to worst case scenarios, but sometimes you often do that. And luckily, none of the situations we've, you know, been faced with have gotten to that point. So, you know, my feeling is, you know, there's a credible possibility that the global community puts a lot of pressure on Russia. That continues, and Russia backs down on this at some juncture. We heard some rumblings about that at the beginning of the week. That would be the first and foremost, the most major of the geopolitical concerns, and certainly help the European economy. Europe is most adversely affected by the sanctions we're putting on Russia right now. So the way I look at it is, hopefully the global geopolitical conflicts remain local and get resolved without turning into major disasters.
You know, Ian, the world is always a dangerous place, I guess sometimes more so than others. How would you weigh the risks in the world today as risks to my money and my portfolio?
Well, certainly in terms of timing, the largest this year is Russia-Ukraine. But it's much, as Art said, the risk. Look, I don't believe it's going to get resolved at all, but I also don't believe it's going to metastasize globally. Those are two different things. And I think one of the reasons why Americans are prepared to shrug this off in terms of the marketplace, they're also prepared to shrug it off politically. Despite everything we've seen, there's very little interest of the Americans to truly engage, to try to stop the Russians. No one believes the present policy is going to do that. That's because it affects Russia, Ukraine, and the Europeans a lot more than it affects the United States. After the 2008 financial crisis, a lot of people believed that the United States was the cleanest dirty shirt. That was true economically, but it's even more true geopolitically. all of the things that you heard Sam Zell talking about, whether it's Gaza, whether it's Iran, it's Libya, it's Iraq, it's Syria, it's Ukraine and Russia, the manifold conflicts, all of which are connected and structural, but all of which affect a hell of a lot more other countries in the world than they do the United States, sandwiched in between remarkably unstable Canada and Mexico. And so I think that's really the issue here.
You know, Art, some people are saying, and we've heard this from a lot of Wall Street market strategists, is that U.S. investors can withstand any of this turbulence because our economy is so strong. We're in much better shape. Do you agree with that, or is there a point where that argument doesn't hold its water?
Well, Susie, that's a great question, and Ian brings up a very good point. You really look at this geopolitical situation and then try to ascertain what that means to you. It's not as though we are isolated from the global economy, and we certainly aren't, but what effect do any one of the geopolitical concerns that Ian just brought up and listed very eloquently are going to directly affect the P/E ratio of the S&P 500 or the U.S. economy and its GDP growth rate for the balance of this year? So as we look at that, there are certainly reactions that could happen. And the biggest concern I would have right now is, as a result of sanctions that have been put on Russia, you're seeing the European economy slow down. It was structurally slowing down before this happened and is getting worse because of sanctions. What has to happen there is aggressive monetary policy. We saw that announced today. The knock-on effect of that will be something like a stronger dollar, a weaker euro, and that can have an effect on your investments if you're overly invested in things that are commodity-based and things of that nature. So you might need to make sector rotation decisions and things that are going to be affected by the reactions to some of these. But, you know, in terms of being isolated from some of this, to a certain extent, there is some isolation. Global geopolitical conflicts, you know, affect locally.
Let me ask Susie's question to you, Ian. What would it take for American investors to react to what's going on overseas? What kind of event would take us from our sort of, hey, it doesn't affect us very much, to, hey, this really does affect us?
So 4 quick things I'd point on. One is if we actually do get a severe recession in Europe as a consequence of the worst case Ukraine scenarios, that clearly is going to knock on all of the trade of the United States with Europe. You can only take so much despite what Draghi's doing. Secondly, likelihood of an Iran comprehensive nuclear deal getting done has actually gone down somewhat because of the distraction of the U.S. away from Iran, so the Iranians don't believe we can get it done, and the willingness of countries like Russia to try to interfere in that. That means oil price is probably going to swing a little bit higher as a consequence. That certainly affects us. Third, God forbid ISIS attacks on American shores. Can't really do much to hedge about that in advance, but afterwards clearly would have a very significant impact on the U.S. economy. But the most significant impact on the U.S. economy is the one that no one's talking about right now, and that is the fact that China is actually engaged in historic economic transformation, which means, and it may or may not work, and if it doesn't, the potential not only for slowdown, but more importantly for the ability of American corporations to do well and make money in China, that is a real risk for us.
That is a very fascinating point. This whole conversation is very interesting. We're going to have to leave it there. Gentlemen, thank you so much. Sure. Ian Bremmer of the Eurasia Group and Art Hogan with Wunderlich Securities. Tyler? Well,
thanks to that ECB rate cut, the dollar strengthened, and that helped move oil prices lower again. Oil, of course, priced in dollars. When the buck bulks up, it takes fewer of them to buy a barrel. West Texas Intermediate down about 8% over the past 2 months. In turn, the weakest sector in the S&P today, energy. As a result, oil companies hits, Anadarko, Exxon, ConocoPhillips, Chevron, all lower.
But that may mean good news at the gas pump because of those falling oil prices, along with a seasonal drop in demand. AAA now predicts that gasoline prices could decline by 10 cents or as much as 20 cents a gallon nationwide by the end of October, as long as there are no hurricanes or other major supply disruptions. The national average right now, $3.43.
It may have been tough getting a burger today at lunch. Fast food workers and organized labor leaders in more than 100 U.S. cities took to the streets today or staged sit-ins, calling for better working conditions and a $15 an hour minimum wage.
And coming up, the big cap stocks analysts think have the most room to run over the next 18 months. That's next.
The U.S. Postal Service is slashing shipping rates for its biggest e-commerce clients by nearly 60% on certain priority mail packages just in time for the holiday season, looking to take away business from its chief rivals, FedEx and UPS. Separately, the Postal Service is launching a trial to deliver groceries in San Francisco through Amazon's Fresh unit.
Home Depot says it's still investigating whether it was the victim of a massive hack attack and if customer credit card data was stolen from its 2,200 U.S. stores. While the chain works with the U.S. Secret Service on the potential breach, it says it'll activate computer chip-enabled checkout terminals at all of its stores by the end of this year to make sales more secure.
If you're an investor looking to bag bigger profits, you need to hunt for stocks with major upside potential. Analysts, as they so often do, insist there are plenty out there, but you have to know how and where to look. Dominic Chu has more.
Investors looking for stocks that could pop often look to the opinions of those who know a company best. Some of those opinions come from analysts on Wall Street that cover stocks for a living. They use price targets and ratings as a measure of what a stock's price will be over the next year to 18 months. Price targets can be helpful to traders looking for investing themes within analyst research.
If I look at a handful of them and they all seem to have the same idea or same thought process, I may take that into consideration on my trading strategies.
Among the large cap stocks currently in the S&P 500, there are only a handful that have price targets at least 20% above where the stock currently trades today. The company with the highest price target on average is Delta Airlines. In fact, every analyst who covers Delta currently has a buy rating on the company. The airline stock has been volatile over the past few months, but analysts say it could be poised to go up by 32%.
It's a very attractive U.S. airline industry, and beyond that, Delta has made some very attractive investments that I think they're just starting to benefit from. So we expect them to continue to do well and generate a lot of cash and return cash to shareholders.
Another popular stock is luxury retailer Michael Kors. Analysts have an average $103 target price for the stock. That's 32% above its current price. And even after its slew of recalls, GM is another top pick from analysts. The automaker has taken a hit this year, but analysts remain bullish with a price target that's 26% higher than where it currently trades today. While analyst opinions are important for a lot of investors, some Wall Street pros say to look beyond the price targets when investing in stocks.
In this day and age with the internet, you can get any of the information that an analyst can come up with very quickly. Everything is out there. I don't think there's any advantage at all to having an analyst report in front of you.
Analysts are just one part of the picture here on Wall Street. And while they may not always be right or wrong, they do provide a basis for some investors to form opinions. For Nightly Business Report, I'm Dominic Chu from the New York Stock Exchange.
A new court ruling on the 2010 Gulf oil spill rocks shares of BP, and that's where we begin tonight's market focus. A judge has found the oil giant, quote, grossly negligent in the Deepwater Horizon disaster. The decision opens the company to the possibility of as much as another $18 billion in fines. BP says it'll appeal the decision. Shares tumbled about 6% to $44.89, their worst day in over 3 years. Profits at Hovnanian soared as the home builder delivered more homes and its margins strengthened, but revenues came in below analysts' estimates. Despite that, shares rose 1% to $4.25. Sweden's Electrolux is reportedly close to buying General Electric's appliance business. It could be a $2.5 billion deal. GE confirmed a month ago that it was reviewing strategic options, but now it looks like it is close to selling that unit. GE shares edged up a fraction to $25.96. Nordstrom shares touched a new high after the retailer authorized a new stock buyback program of up to $1 billion. This adds on to the more than $320 million left in its existing repurchase program. The stock was up 1% to $70.43, closing below that record.
The Dow component Verizon has hiked its quarterly dividend. The nearly 4% increase will bring the payout to 55 cents a share. It will be payable on November 3rd. Despite that, shares were down a fraction to $49.72. And we've got a mattress merger to tell you about. Mattress Firm, yes, that's its name, Mattress Firm, not Firm Mattress, is buying privately held Sleep Train for $425 million in an effort to expand its presence on the West Coast. Also, Mattress Firm reported better than expected first quarter profit. Investors will sleep better tonight. Shares were up 10% to 62.69. Verifone also out with results that topped estimates. The company raised its first full-year revenue forecast for the third time, encouraged by strong sales of its device that can accept chip-embedded credit cards. Shares popped 1.5% to 35.05. And Mobileye reported sharply higher revenue just 1 month after going public on strong demand for its products. The company makes cameras used to avoid car crashes. Still, shares down today almost 3.5% to 45.37.
Automakers are still revved up on delivering strong sales in August, but that wasn't the case for all vehicles last month. According to automotive research company Edmunds.com, sales of electric and hybrid cars have stalled this year, grabbing just 3.6% of the market. That's down from last year's share.
Meantime, one electric car maker is betting on powerful sales of its luxury autos, Tesla. And today, the company will unveil plans to build a brand new $5 billion lithium-ion battery factory in Nevada. And that's where we find Phil LeBeau with more on today's announcement. Phil, good evening. Why Nevada for this gigafactory?
Well, Tyler, look at this strictly from a manufacturing and a logistics perspective. It makes perfect sense for Tesla. The Gigafactory is going to be just outside of Reno along I-80. Go 4 hours to the west, and you have the Tesla plant in Fremont, California. So logistically, they can build the batteries here. They're going to be building this factory in conjunction with Panasonic. The only active lithium mine, and remember, they're making lithium-ion batteries. Well, the only active lithium mine in the United States is in Nevada, and there's a rail line there. Let's say they capture lightning in a bottle and they eventually want to ship out to Asia. Well, that rail line goes to the port of Oakland. So logistically, this makes perfect sense in terms of what Tesla is trying to do. And, of course, Nevada is going to be stepping forward with plenty of incentives to make sure this is a good project.
Right. So does it make sense for Nevada? How much is it going to cost the state? And is it money well spent? What are you hearing?
Well, the incentive package is going to be anywhere between $400 million and $500 million. It still needs to be finalized by the state legislature, but I've talked with a few lawmakers here, and almost everybody says, look, we'll eventually get it done. You don't have this many opportunities, Susie, to land a manufacturing plant that could bring 6,500 jobs. Is $500 million a lot in incentives? You bet. But it's not very often that you can bring 6,500 manufacturing jobs into one area, and that's why Nevada believes this is going to be money well spent.
So, Phil, this is a $5 billion investment. $5 billion. That means you got to sell a lot of electric cars. What if the demand for those cars, those Teslas, never takes off? Will they consider, for example, selling those batteries to other vendors?
Yes. Yes, and that's the whole idea. These batteries are not strictly for Tesla. They will be for other electric vehicles. They will also be using the energy that they create or develop within this gigafactory to sell to energy companies. So there is a component here of these batteries being used for the energy industry. So, yes, some are calling this a moonshot, but Tesla believes that there's going to be plenty of demand there.
Phil, thanks very much. Phil LeBeau from Nevada tonight.
Google is about to make a lot of parents very happy after reaching a settlement with the Federal Trade Commission. It's agreed to refund at least $19 million to settle charges that it unfairly billed parents for in-app purchases made by their children without an okay from mom or dad. Apparently, kids bought hundreds of dollars worth of goods while they were playing some popular mobile video game.
And that'll do it for Nightly Business Report for tonight. I'm Tyler Matheson. Thanks for watching.
And we want to wish you a very happy birthday.
Thank you very much.
Hope you have some good plans for tonight.
I do. We have a lovely evening planned. Thank you all.
Have a great evening, everyone, and we'll see you back here tomorrow night. I'm Susie Garrett with the Nightly Business Report News Brief. European central bank officials gave global markets a big boost after a surprise cut in interest rates and announced plans for new stimulus measures. But investors here in the U.S. pulled back from intraday trading highs on worries about Friday's August jobs report after weaker than forecast jobs data out today. The Dow was down 8 points, the Nasdaq lost 10, and the S&P off by 3 points. Shares of BP sank 6% after a judge ruled that the oil giant was, quote, grossly negligent in its role in the 2010 Gulf of Mexico oil spill, making it subject to billions of dollars in penalties. BP will appeal the ruling. And thanks to falling oil prices and a drop in demand, AAA predicts gas prices could fall as much as 20 cents a gallon by the end of October. Be sure to tune into Nightly Business Report right here on your public television station.